Okay, good morning, everybody, and welcome to the Daily Energy Market Podcast. It is Friday, the 6th of December. I think in different geographies, that's the beginning of Christmas or some version thereof. The three wise men started marching on the 6th, was it? I don't know. I knew it all when I was a young fella, but I can't remember what it was. But nonetheless, what we do know is that Brent crude oil barely has a heartbeat this morning. It's basically flat, not up a penny or down a penny at $72 on Brent after the big news yesterday. Not so big in the end, it would appear. OPEC Plus deciding to extend their current plan for an extra 3 months through the first quarter of 2025. Much expected, it would appear, by the market reaction. Let's kick off this morning with Robin Mills, CEO of Kamar Energy, for his reaction. Robin, have they done enough to ensure they've got a floor of $70 Brent for the first quarter? Your thoughts on the decision and the outlook for price?
Well, a floor, I'm not sure. I mean, we're only hovering just above 70 as it stands. I think it was 72 this morning for Brent, and there's a lot of factors that could easily see us dip below that. I mean, they've obviously this action helps, I think, trying to defend that floor, but doesn't guarantee it by any means. No, and we've seen the past couple of months persistent downward pressure. It's only a few podcasts ago that we were talking about defending 80, right? So it is proving a challenge. I mean, look, I think the move is pretty much expected, even for a week or two beforehand, and with the delay in the meeting, it was clear there was some discussion along these lines of delaying these cuts, even the restoral of the cuts even further. But now we're looking at a scheme of cuts that goes into 2026, and even the UAE's scheduled increase has been put back yet again. So yes, overall, I think bowing to the inevitable. But OPEC, I think, is digging itself further and further into a hole with this. And we could hindsight's a wonderful thing, but you could look back at 2022 and say maybe there was a different path from that point.
Well, let's go to China. Victor Yang, senior analyst of the JLC Network Technology. Of course, Victor, China remains the critical market for OPEC Plus, for Saudi Arabia, the biggest producer or exporter within OPEC Plus. And the outlook there as we come to the end of the year, your thoughts on the OPEC Plus decision and the demand outlook for China into the first quarter?
Well, good morning, everyone. Yes, well, now the market is waiting for the country to release its quota on 2025 crude imports and its quota on oil product exports.
Sorry, 1 second, Victor. Sorry, just 1 second. I'm struggling to hear Victor. Is there any way we can turn up his volume, or Victor, you can speak closer to a microphone, or is it just me?
Sorry. The market is now waiting for the country to release its quotas on crude imports for 2025 and the quotas for oil product exports too. Usually, the country releases the quotas at the end of December or the beginning of January, normally at the end of December. And for 2025, when we talk about crude imports, and the country is now releasing the quotas on the whole year, the quotas at all at one go now. I mean, as from 2024. And for 2025, we still expect a modest increase in the quotas. And the country has raised the ceiling for 2025. And so for the first quarter, as we had the Chinese New Year at the end of January, we expect a drop in the demand for gasoline and jet fuel. And the refining run rate will also go up in January. So we expect a rebound in the country's crude demand in the first quarter too. Yes.
And Victor, just to clarify your point there, you're saying that the quotas for imports into 2025 will be released or announced in one block, whereas previously it's been what, every quarter, or what is different?
Well, before 2024, it was announced in several batches, usually 3 batches. And at the end of the year, say the last quarter, if some independent refineries were short the quotas, were running short of quotas, they would apply for additional quotas for the year. But these quotas would be counted as part of their quotas for next year. Say, for instance, in October, some refineries ran short of quotas. They apply for additional quotas, but their quotas would be deducted from next year. And now as from 2024, the country announced the whole year's quotas all at one go. And that was different from before. Yes.
Charles, your thoughts on the OPEC Plus decision, the idea that we have had obviously this effort to keep the markets in balance, as OPEC Plus would call it, but ultimately to keep the price supported as well. But a sort of lower end of the range price, lower to 70 than 80, has got to be good news for Europe at the moment. Can Europe take advantage of these lower energy prices at this somewhat difficult time it's facing?
Well, it has to, because Europe is facing huge problems with gas and electricity prices. The gas price has gone up by over 200% since the beginning of the year. And lower petrol prices are offering a sort of a respite out of these high energy costs. But, I'd like to add that OPEC is perhaps playing a wait-and-see game here, because, as Vitol said, the oil production next year by non-OPEC countries may not be what we all thought it could be, because with Trump coming into the presidency and possibly sanctions applied to Venezuela and Iran, their production may go down. And ExxonMobil also has come out publicly to say that they're not going to go and drill, baby, drill. They're going to follow a more cautious approach, and expectations are that oil production in the United States next year will only go up marginally. So non-OPEC oil is not going to increase as much as everybody has been saying next year. It may be a lot less. So OPEC's position may prove to be a wise one in the end.
Well, I suppose, Robin, just picking up on that point, I mean, the idea that you articulated in your earlier point that the OPEC Plus have got themselves in a bit of a corner and a bit of a hole here, trying to get out of these cuts, 6 million barrels a day on it at the moment. They could have gone with that option, I suppose, of adding back the barrels and tolerating a lower price for a while, because as we're saying, Charles indicating there, in the US, even at $70 Brent, are unwilling to add too much capacity because the cost attractiveness of that is not there. Your thoughts on that, whether by default or design, $70 Brent will knock out new supply?
Well, I think clearly the policy pursued so far, let's say since 2022, when these extra cuts came in, has been supportive of non-OPEC output, right? And the US mostly, but not just the US, also Canada, Brazil, and then the new entrants like Guyana, and so that it's particularly the Americas, they're all booming. So what price would curtail a significant amount of that supply? Look, I think Guyana's a done deal; those investments are committed. That's coming. Probably Brazil is coming, but the US, that's a place where you could have seen cuts. US drilling is way down, but drilling efficiency is well up. So the US supply has remained still pretty strong. Yes, there's an expectation that will slow down into this year, but we've seen this expectation that US shale growth will slow down so many times, and it usually surprises to the upside. But I think if we saw a significant lower price, let's say we saw 60. Then you would see a definite slowing of US growth and more room for OPEC to bring back production. But I think 70 is still pretty supportive of drilling and US production expansion.
Victor, looking at the China demand outlook for 2025, of course, we've been being that was kind of the dominant subject of 2024, the economic well-being of China, the GDP growth. Would they get to their 5% target for the year? And what the stimulus that is coming a few occasions towards the end of the year. But now we have the Trump return to the presidency and the threats of significant sanctions on China. And then China now announcing in the last few days bans on the exportation of rare earth materials that are needed in the global industry. I wanted to get your thoughts on how you think this will play out, the China-US, with the sanctions coming from the US, China's reaction to that. Are we likely to see more of these sorts of things like the ban on rare earth exports? Your thoughts on China's reaction to Trump's tariffs?
Well, it will be more challenging for China next year. And the decoupling and the trade barriers is increasing from the United States and some other European countries too, such as for the export of UCO, yes, used finishing, using the cooking oil. And while China is now focusing more on domestic consumption to drive its economic growth and trying to boost the trade with the Belt and Road, the countries along the Belt and Road Initiative too. So it's trying to reduce the impact of the Trump administration on China. So it's it will be more challenging, that's for sure. But it's now also discouraging some the exports of some products, such as oil products too. As we know, China has announced a policy to cut the tax rebate for the export of gasoline, diesel, and jet fuel, which took effect on December the 1st. We can regard it as a sign of discouragement for oil product export and some other product export, a large variety of product export too.
Why is that? So they're reducing the export quotas for products, China into Asia, other parts of the world. Why is that?
Well, we could regard it as part of the measure to drive up the industry upgrade and for the gold emission target. As we know, China is now pushing forward with the industry upgrade, including in the petrochemical industry. And it's trying to, push up this industry upgrade by increasing competition, because sometimes it might be more efficient than political measures. And as we know, it's now getting increasingly competitive in the domestic market as new refineries are more competitive, and conventional and all independent refiners are getting, outdated. So this will push them to upgrade their unit configurations and to become more competitive. Yes.
Charles, it's a rather unique moment for Europe this new year. We've got the German government facing an early New Year election, the biggest economy in Europe. We now have France. If they don't have an election, they're in either ways in political paralysis and divided government, etc. The two biggest influential countries in the European Union, at a time when Trump is coming back into power and signaling a serious intention to sort of wind down the Ukrainian war at what would appear to be Ukraine's loss as such, Ukraine's compromise. I'm just wondering how you put that together, weak Europe at a time when Trump's likely to enforce a solution that they're in no position to fight because they don't have governments. I mean, how is this going to play out, do you think, and its ramifications for energy flows as a result?
Well, Europe is in addition to that, we also have a new commission now. The Ursula von der Leyen has just announced the new commission, and they're only going to take their positions in the near future. So everything is in a state of flux in Europe. The greatest problem at the moment is that there is an expectation of an energy crisis. There are many factors which are creating a problem in energy in Europe at the moment. The past 2-3 months have been cloudy, have been with low wind speeds, no sunshine. As a result, renewable energy has gone down dramatically, and reliance on gas for energy production, for electricity production, has increased dramatically. And the withdrawal of gas from storage has been much more than expected. It's the highest it has been the second highest it has been for the past over 10 years. And there is a concern that gas supplies may become problematic later next year. In addition to that, the flow of gas through Ukraine is coming to an end at the end of this year, and there is no clear way forward. And electricity prices have gone up at the same time. There are other issues, like the Americans have applied sanctions on Gazprom Bank, making trading of Russian gas a bit more difficult. All of these factors are coming together to make the situation for energy in Europe a bit problematic. Not clear how Europe is going to react to that, especially.
Will that sort of add to the likelihood that Europe will welcome a Trump solution for Ukraine, that they won't fight it because A, they don't have the politicians because they're all losing their jobs, and B, with the energy crisis just emphasizing the burden of this war, if Europe has to foot more of the bill with Trump backing away, that everybody will kind of be in alignment towards a fading out of this conflict. Your thoughts on that direction of travel into 25?
That may be an underlying factor, that even though the Europeans are not very happy with Trump and everything else, they are not really doing much at the moment to counteract the possible impact of Trump on Ukraine. They seem to be sort of tacitly following that, maybe on the lines you described. I mean, they haven't said anything publicly, but on the other hand, they haven't also come out publicly strongly pro-Ukraine and trying to take the lead on Ukraine away from the United States. They have NATO has been trying to stir some interest, but overall, we have not seen any active taking position of Europe with regards to Ukraine. I think there is a wait and see situation rather than one of trying to take the lead and trying to solve the problem as a European problem.
Let's go to the survey question, which is tackling the first question I asked Robin this morning, which is, OPEC has done enough to keep Brent crude oil above $70 average through Q1. Agree or disagree with that statement? OPEC has done enough, rolled over all its cuts for another 3 months to the end of March. That will be enough to keep Brent average $70 or above, the floor of $70 or above through the first quarter. Robin, I wanted to get your thoughts on, as you mentioned in your earlier comment, that built into this decision yesterday was also the idea of postponing UAE's increased quota, which was due to start on January the 1st, and something that the UAE has been lobbying for a number of years, and they got an incremental piece, I think it was 2 years ago now, on their quota. But they are carrying a very large amount of idle capacity, as are many countries in the Gulf. And I wanted your thoughts on the cost of these countries continuing to not only carry this large idle capacity, but also to be continuing to add to it, because they're all investing. Well, Kuwait is, and Oman is, and UAE is investing in further capacity increase. How long can those two things continue to coexist? Your thoughts and the guidance and advice on that?
Well, look, I think this is really an issue for the UAE and you could say Iraq as well, right? Those are the two that have major production expansion plans that are actually going into action and are increasing their capacity. And the UAE is the most advanced on that. You know, as you say, it has proportionately the most idle capacity out of any OPEC member. So it's yeah, this is kind of frustrating for the UAE that this process keeps going on. The cuts keep being rolled over. The UAE's scheduled increases now put back yet again. That was a bit of a special deal the UAE got to keep them happy, but that's now been delayed too. The UAE, you know, is pushing well towards the 5 million barrel a day capacity and should be there in the near future. And then even concepts to go to 6 million a day capacity. You know, while as we know the Saudis have shelved their production expansion. I think for the others, you know, Oman, you know, Kuwait talks about expansion. If anything, it's just about keeping up capacity at most. And Iraq has probably 2+ million barrels a day of new projects, but those aren't necessarily approved yet. So that's less of an urgent thing for Iraq. It's really an issue with the UAE. Has OPEC done enough to keep them happy, to keep them in the deal? You know, yes, for now. But this is a persistent tension, and the UAE, of course, keeps pushing for to be allowed a higher output. Look, I think a couple of things in the UAE's in favour of the UAE's continuing with the deal. One is that the financial situation is comfortable, unlike Iraq, let's say. UAE is financially and economically is doing very well, so it can live with this extra capacity, this spare capacity for a while. And secondly, there are other gains. There's gains in gas, and then because of that, there are gains in condensate. So outside of crude oil, the UAE revenues are rising anyway, and that condensate does help offset some of the frustrations on the crude side.
Victor, one of the question marks going into the new year is whether China will continue to be the main importer of Iranian exports as the U.S. Trump administration brings a greater rigid enforcement of the sanctions on Iran exports. Your thoughts on that? The Chinese importers likely to continue to take that oil. There's some indication that maybe it's already started to come off a little bit. Your thoughts on the outlook for China's imports of Iranian oil in the first half of next year?
Well, private refiners have become a little bit more cautious about taking such cargoes lately. And as we heard, well, there's been a drop recently. But this would not be, this would be temporary, we believe. And over the longer term, say next year, it would be gradually back to previous, normal. And China will still be the main importer of such crude cargoes, because I do not see anyone else, taking such large volumes from Iran, yes.
But the willingness of China to continue to do so, you think, is there given the discount and the attractive quality of the crude?
Yes, particularly in private refiners, because they are already struggling with bad refining margins this year. And even for imported crude with discount, their margins are still bad in 2024. So this would be the biggest attractiveness for them, yes, to continue in 2025 too. Otherwise, they wouldn't be able to, I may not say survive, but it would be very difficult to continue, yes.
Just to follow up on that idea that you had mentioned in our earlier comments, that China is having a difficult time, a difficult year, and now with Trump and the tariffs coming, could put a more difficult strain on the economic performance of China next year. In the big picture of expectation, Victor, do you think China's oil demand consumption in 25 could decline again? I mean, this year it declined a little bit. Do you think next year it could also decline again? Or what is your expectation for the year as a whole?
We expect a modest rebound in 2025 because we see in 2023 there was a jump, and then in 2024 it retreated. In 2024, a lot happened to contribute to the decline, particularly the surge of LNG powered trucks at the beginning months of the year. We still see fast development of such alternative energy, but not as fast as in the first few months of 2024. As we know, the price difference has now narrowed quite significantly. And another factor is the real estate industry. We do not expect such a decline again in 2025. And some industries will also recovering gradually, but not as strong as before, but they're still recovering gradually. So we do not expect it to drop again like in 2024. And another fact is, well, the removal of old and outdated refiners is still quite slow. And we still see increasing capacity, such as the new refiner in Europe, in Shandong, that came online in September this year. And when we expect an increase in the country's non-state crude import quotas too for 2025, yes.
Dr. Charles, given the, let's say, the likelihood of all of the indications are pointing towards some kind of resolution or freezing of the Russian-Ukraine conflict. I mean, whether there's a land for peace deal or it's just something, but let's just assume it kind of finds a détente. Where does that leave energy flows, do you think? Because at the beginning of this crisis, we were all sort of thinking, and I know you had a lot of focus on the East Med, that we were going to look at new sources of gas supply to Europe coming out of possibly the East Med or possibly the Caspian. That doesn't seem to have really had any progress. Egypt is still struggling. It's now a net importer of gas again. US, of course, has been a big winner in terms of the European market, but the resolution or somehow the end of the conflict, the hot conflict in Europe, are we likely to go back to energy flows that were there before? How do you see it playing out?
Going back, I think it's going to be very difficult. I mean, even though there is an increase in view that the Ukraine situation will be resolved in the longer term, maybe Russian gas may come back to Europe. The actions being taken at the moment are in the opposite direction. As I said before, Ukraine is stopping the gas flows through Ukraine. OMV, that had long-term contracts with Russia, is severing those. Now, the view at the moment is that, expressed by some European politicians, but also by Lagarde of the European Central Bank, is to increase LNG imports from the United States. They believe that Trump's threat of increasing taxes on levies on European imports may be moderated if Europe is prepared to increase LNG imports from the United States. So there's a growing view that may become not just an idea, but a reality next year, that LNG imports from the United States will come to replace the loss of Russian gas that is not coming through Ukraine. As you
And
said,
does Europe have the infrastructure for that?
they have built many new LNG import terminals, and there is spare capacity to achieve that. As you said, imports from the East Med are not going anywhere. Egypt has become a net importer. Azerbaijan, I was there end of November for the COP29 conference. After the outburst of Aliyev against Europe, against France, the relationship with Azerbaijan is cooling down, but also Europe is not prepared to make any long-term commitments to Azerbaijan to invest in developing the new gas fields needed to send more gas to Europe. So I think we are ending up in a situation where it's a one-way street, more US LNG.
From one dependency on Russia to another dependency. Well, Trump was screaming about that when he was last in power, so he'll be certainly happier about the current arrangement. But I wonder how he manages to do a deal with Putin while at the same token keeping his European market to America rather than giving it back to Russia. I'm not sure that is that a win-win or not, but that will be a difficult conversation. So OPEC has done enough, according to this room, to keep Brent above 70. Let's see how that plays out in the first quarter. But that leaves us shutting our podcast with Brent crude oil. Little change this morning in Asian trade after the OPEC Plus decision, $72 on Brent. Can it hold above 70? Can it hold as it digests this news from OPEC Plus? We'll have to see. But Robin Mills, CEO of Camera Energy, thank you so much. We probably won't see you again before the holidays. We might see you in person for a change. But nonetheless, Robin, thank you as always. Your insights are amazing. Victor Yang, Senior Analyst at JLC Network Technology in China. Thank you so much, Victor, for all your engagement this year. And Dr. Charles Elinas, CEO of Cyprus Natural Hydrocarbons Company and a Senior Fellow at the Global Energy Center for Atlantic Council. Thank you, Charles, for all of your engagement this year. Have a great holiday season, and we look forward to seeing you all at the big event on January 9th to kick off the new year, the Global Energy Outlook Forum, which we do every year to give a big 12-hour, 12 time zone, 50 market analysts from around the world. That will be an exciting day to get a good deep dive on the year ahead. But we'll be back next week for our last week before the end of the season. Thank you, guys. Have a great weekend. All the best.
Have a great weekend.
You.
You too. Bye-bye.
Bye.